Here's my quick take on the economy. I do think the economy is prepped for a really, really big expansion. I think that Obama has been a complete break on the natural forces of recovery that you would see. This is, I'm not telling you anything you don't know. This has been incredibly anemic recovery. In fact, I don't think we should even be calling it a recovery. Half of Americans think we're still in a recession, and for at least half of Americans, it is still a recession. I did a piece in the Journal about 6 or 9 months ago that just annoyed every liberal in America. It's just called Reaganomics versus Obamanomics. And one of the things I did was I basically compared what happened under Reagan versus Obama. I think actually Mitt Romney brought this point up in the last debate, but it's pretty stark. I mean, look, the one thing that Reagan and Obama had in common is they both took over in the midst of an incredible economic crisis with the U.S. economy faltering. I graduated from college in 1981, so I remember back then how bad it was. How many remember like 14% inflation and 20% mortgage interest rates? Back then in 1981, you couldn't even get a job as a burger flipper with a college degree. And of course, Obama inherited a crisis of at least equal magnitude. So that they had in common. They came in right in the midst of that. And they, of course, used diametrically different approaches to dealing with the crisis. Reagan came in, he cut tax rates from 70% down to 50%, down to 28%, an enormous reduction in the burden of taxation. Reagan deregulated the economy. Reagan and Volcker got inflation under control, withdrawing easy money out of the economy. Whereas Obama came in and did exactly the reverse. He engaged in this huge Keynesian stimulus plan, cash for clunkers, all of these. By the way, I just saw this wonderful cartoon the other day. I just had to mention that, after the debate between Biden and Paul Ryan, there was a picture of a cartoon of Barack Obama holding Joe Biden like he was a piece of lumber and going up to this window, and it said "cash for clunkers." But anyways, the point I was making is just to give you some of these statistics, because it really does show, this is why Larry and I are in this game, right? Policy really does matter. And under Reagan, at this stage of the recovery, the U.S. economy was growing at 6.5%. And we actually had quarters, believe it or not, where we had economic growth rates of over 8%. And can you imagine how hard Barack Obama would be to live with if he had an 8% growth rate? I mean, he'd be doing, he'd doing cartwheels down Pennsylvania Avenue. We were creating about 300,000 jobs a month. In fact, in 1 month under Reagan, in October of 1983, the U.S. economy created 1.1 million jobs in 1 month, which is, unbelievable. Under Obama, and I think actually one of the strongest lines that Paul Ryan and Mitt Romney have used in these debates is the fact that the economy is actually getting weaker. It's not getting stronger. And I think they both said this, that the economic growth rate of 1.3% now is slower than it was last year, and the economic growth rate last year was slower than it was the year before. That's a pretty anemic recovery, and it's a point that Obama needs to, that Romney needs to keep. I think that the failure of last night's debate was that Romney didn't take the advice of myself and Larry Kudlow and others who just said, make this debate, this foreign policy debate about the economy. Because really foreign policy and military policy and our affairs abroad are all completely affected by our economy. We can't be strong abroad if we're weak at home. And I don't think Romney made that point strongly enough. I wanted to make one last point, just to kind of throw this up for kind of food for thought for some discussion, which is that one of the things that I find most curious about this economy right now is what's happened with inflation and interest rates. Because how many of you read the Wall Street Journal editorial page? I think most of you probably do. One of the points we've made, we've been very severe critics of the Bernanke easy money policies, QE1, QE2, QE3, what we call QE infinity right now, because there's no cap on what they're doing. And there's no question of not just the last 2 or 3 years, actually the last decade, we've lived in an incredible easy money, low interest rate policy with the Fed just flushing the economy with cheap dollars. And one of the things that's been curious about that is that you would expect, if you look at a chart of what's happened with money creation since the economy collapsed in October of 2008, you'll see that the amount of money creation, the amount of money that the Fed has been pouring into the economy is well over double than it was in September of 2008. So that is to say, there are about twice as many dollars floating around in the world economy today as they were 4 years ago. That's a big increase in the supply of money. Huge, unprecedented. Now you would expect, of course, as a result of all that money, you would expect inflation, right? We all know this from your economics 100 class, that inflation is too many dollars chasing too few goods. And yet the kind of paradox is that for the last 3 years, there's actually been very little inflation. Until very recently, we're starting to see prices rise up. But clearly in 2008, 2009, 2010, even the first half of 2011, inflation was very tame. In fact, in 2009 and 10, we had the lowest CPI increase in any time in 40 years or so. That's a kind of paradoxical thing to have happened. The Fed is flushing the economy with money, prices are remaining stable. And I think one of the explanations for that is that people were so fearful they didn't want to go out and spend, and the velocity of money was reduced significantly. So inflation has actually resulted in the amount of money plus times the velocity of money, and the velocity of money fell. Now here's the interesting part. We're starting to see these prices rise again. For example, it is not a coincidence that the price of gasoline has doubled under Obama's presidency, and since this flush of cash has been put in the economy. Commodities are always kind of the best leading indicator of where prices are going, and when you see a doubling of the price of gasoline, it is not because of supply disruptions in the middle. I mean, there have been some supply disruptions, but that's not really what's happening here. What's happening here is that you're starting to see commodity prices as kind of the canary in the coal mine, the first signs of inflation. But here's the other interest, and by the way, that does mean that if the economy starts to pick up, we're in a little bit of an economic pickle right now, because as the economy does pick up, I think you're going to see inflation rates start to pick up because people are going to start spending more. But the other part of the equation I think is really interesting is what's happening with interest rates. And I'm just going to mention this, and then I'll turn it over to you all for discussion, which is that we're seeing something right now in the U.S. economy that I, as an economist, believe never could happen, which is to say that we are now seeing negative real interest rates. And we used to say interest rates can't go negative. Well, they have gone negative, and not just in the U.S., they've gone negative in a lot of countries. And just to give you an example of what I'm talking about, if you look at what's happened with the 10-year Treasury bill, you probably, some of you probably looked at these numbers more recently than me. What is it at now? Like 1.7%?
Yeah, just under 1.7.
Okay, so let's say it's 1.7. Well, the CPI came out last week, and the overall CPI, not the core inflation, but the overall inflation rate, is somewhere between 2.5% and 3%. Let's just say it's 3% for rounding purposes. Well, that's an amazing thing. What that means is that all of us in this room and everybody around the country and everyone around the world is engaging in this incredibly psychotic behavior, where we're actually buying essentially what a negative 1.3% interest rate means on these 10-year Treasury bills, is that we are buying 10-year Treasury bills today, and the government is promising 10 years from now to pay us less money 10 years from now than we're lending to them. That's amazing. I mean, when does that ever happen before? Why are we doing that? And the answer, of course, I mean, I think you're all very financially involved in these things. The answer, of course, to that question is that four-letter F word, right? Fear. And fear is the overriding sentiment in the economy right now. And this fear has been really with us for the last 4 or 5 years. And fear is, what is the old saying? That two things drive the market, fear and greed. Well, what we've had for the last 4 years is just this black cloud of fear that is holding back the economy. And I, as I mentioned, I go around the country talking to not just political groups. I give a lot of talks to investor groups, business groups, and so on. And it's just amazing that the universal sentiment, especially when I talk to business owners. For example, I gave a talk a few weeks ago to one of my favorite groups in the country, which is the International Franchise Association. These are people who own McDonald's and Applebee restaurants and Burger Kings and Dunkin' Donuts. I mean, these are guys on the front line of the economy. And they all said that they're just holding back, that they don't want to reinvest in the business right now, that they just want to kind of hunker down. They're in a kind of cocoon, they're still in a kind of survival mode. Here we are, by the way, that's amazing. We're in the 4th year of what should be a recovery, and they're all like this. And a lot of them are saying, and the reason we're in this survival mode is because of Washington. Well, they were just afraid of the next grenade that Washington is going to throw at us. And another example of this that I'm talking, I mean, it's just so interesting to talk to real people on the street. But one of the guys at this meeting that I talked to came up to me after my speech, and he just said, I agree with what you said, but he said, it's even worse than you say it is, Steve. And he said, you were talking about Obamacare. He said, look, I have, he said, I have 40 Mexican restaurants in the Dallas-Fort Worth area. And he said, I have about 1,000 employees at these 40 restaurants. And he said, I've done the calculations for 2013 and 2014, and Obamacare is going to cost me about $1,250 per employee. Well, we'll do the math. 1,000 employees, $1,250 per employee, that's $1 million Obamacare is taking out of this one little business. Well, that's probably 20 less employees that firm can hire. So that's what I mean about these kind of grenade shots that are being tossed at these businesses. And the point I'm making is that I do think the reason this election is so important is one of the things that we've learned from past elections is that if there's a kind of political element to this fear factor, and I do believe so. I mean, I actually think if Romney, and I'm not saying this because I'm a rah-rah Republican. A lot of you know me, and I'm not. I'm not wild about Mitt Romney. There are a lot of things I disagree with him on. I thought last night he sounded like Herbert Hoover on trade in China. I thought he was just awful on that issue. But I do think that if you get a Romney win, I just think you're going to see this economy explode. I really do. I think you're going to see an 80s, 90s type of expansion. And again, not because Romney's going to come in and do all these wonderful things. Maybe he will, maybe he won't. But I just think getting the community organizer out of the White House will have such a profoundly bullish impact. And if you don't believe me, I mean, it's interesting. One last point, I promise it's the last one, is that if you look back in 1994, the last time you had that big, remember that big Newt Gingrich wave that we had after Bill Clinton's first 2 years in office. It is amazing, if you look at it, when you go back to your office, look at a stock market chart or look what happened with interest rates. That night, people weren't anticipating that election result. And we kind of forget that even about a week before the 1994 elections, a lot of people thought the Democrats would continue to hold the House. There would be Republican gains, but people weren't predicting enormous Republican gains like what happened. And what happened is that literally within 24 hours of that election, the stock market just went through a 5-year bull market like we've never seen in this country. I mean, and it started literally within 24 hours of the election. Same thing with interest rates. As soon as the election, was held, those interest rates started to fall dramatically. The point I'm making is I think you could see that kind of really bullish, optimistic result if we get a regime change in 2 weeks. I really do. Now, look, the economy might, just because of the natural forces, the animal spirits of the entrepreneur in America, we could even see a good year in 2014, even if Obama is reelected. But I think the chances of a really, really strong recovery are much higher if we have a Romney win. So.